Welcome to Module 4. Thus far, we've structured our financial data and determined unit costs. Now, we turn to a pivotal concept in business decision-making, the break-even point. The break-even point represents the precise level of sales at which total revenues equal total costs, where a business transitions from operating at a loss to generating profit. It serves as a critical benchmark for strategic planning, pricing decisions, and risk assessment across various industries, including those represented in the Fortune 500. To illustrate, imagine a mountain ascent. The climb symbolizes the investment and operating costs incurred before profitability is achieved. The summit represents the break-even point, and the descent marks the phase where each additional sale contributes directly to profit. In this module, we will calculate the break-even point using standard financial formulas. Apply Excel's advanced what-if analysis tools, such as goal-seek and data tables, to model how changes in price, cost, or volume impact profitability. Visualize break-even dynamics through charts that clearly depict fixed costs, variable costs, total revenue, and profit zones. By the end of this module, you'll be equipped to perform break-even analysis with precision and use it to inform strategic decisions in real-world business scenarios. Session 1. Understanding the break-even point and its strategic importance. What is the break-even point? The break-even point is the level of sales, expressed either in units or revenue, at which a company's total revenue equals its total costs. In simpler terms, it's the point where profit is exactly zero. At this stage, the business is covering all its costs but has not yet begun to generate profit. Thus, there's no profit, there's no loss. Why is the break-even point critical? This single metric plays a foundational role in financial planning and strategic decision-making. Here's why. Survival threshold. It defines the minimum sales volume required to sustain operations. Knowing this figure helps businesses set realistic monthly sales targets to remain solvent. Pricing strategy. It informs pricing decisions by showing how changes in price affect profitability. Businesses can use break-even analysis to evaluate whether their pricing structure supports their profit goals. Risk assessment. A high break-even point may indicate elevated fixed costs or low contribution margins, signaling greater financial risk. This insight is especially vital for startups and businesses undergoing expansion. For entrepreneurs and managers, break-even analysis is not just a financial exercise. It is a strategic tool for navigating uncertainty and optimizing performance. Calculating the break-even point. The role of contribution margin. To calculate the break-even point, we first need to understand the contribution margin, a key metric in cost-volume profit analysis. The contribution margin formula is given by contribution margin per unit equals sales price per unit minus variable cost per unit. This margin represents the amount each unit contributes toward covering fixed costs and eventually generating profit. For example, the classic sourdough loaf in our GreenLeaf Bakery's data has the following pricing and cost data. Sales price: 3,500 Nigerian Nairas. Variable cost: 1,455 Nigerian Nairas. Therefore, the contribution margin equals 3,500 Nigerian Nairas minus 1,455 Nigerian Nairas equals 2,045 Nigerian Nairas. This means that each loaf sold contributes 2,045 Nigerian Nairas toward fixed costs such as rent, utilities, and salaries. 2,045 Nigerian Nairas. This means that each loaf sold contributes 2,045 Nigerian Nairas toward fixed costs such as rent, utilities, and salaries. Once those fixed costs are covered, the contribution margin becomes net profit. Activity 1. Apply the concept. Using your inputs sheet, TBL_vis_details from Module 3, calculate the contribution margin for each of your product lines. Post your results in the comments section for peer review and discussion. See you in Session 2. when we'll elaborate on break-even in units, break-even in revenue, and break-even in multi-product scenarios. See you then.